There's a new development in the retirement investing world that's raising serious red flags. The growing push to include private investments, especially private debt, inside 401k plans. At first glance, this may sound like innovative new access to elite strategies, but the truth, it's more likely about Wall Street's urgency to offload product, not necessarily what's best for investors like you. Since the post-COVID fundraising peak, private investment firms have had to compete with public markets that have delivered strong returns, prompting many institutional investors to favor liquid, transparent, and lower-cost options. As you can see, this has resulted in a decline in global private capital fundraising over the last 4 years. Furthermore, Yale and Harvard endowments are now actively looking to reduce their exposure to private investments. These institutions have historically maintained high allocations to private equity and private credit. But in today's environment, with uncertainty in the markets, federal fundraising questions, and interest rates staying elevated, they're finding that the illiquidity of these assets is a greater concern. As a result, they're trying to offload positions, adding even more pressure on private investment firms scrambling to raise capital. So now, many firms are lobbying to expand into the 401k market, tapping into a massive pool of everyday retirement savers. Here's why that concerns me. Private investments are not like mutual funds or ETFs. They don't trade daily. They can have very high fees, 2 to 6% isn't uncommon. More importantly, they're illiquid by design, meant to be held for years. Yet, to make them fit inside retirement plans, some providers are now building these illiquid investments into structures that offer daily liquidity. That long-term lockup is precisely why these investments might offer something called an illiquidity premium, a little extra return for giving up access to your cash. But when you wrap those same assets into a fund that offers daily withdrawals, you're breaking that relationship. Let's say redemption surge. Maybe there's a downturn or a wave of fear in the market. A liquid fund can sell assets quickly to meet those redemptions, but a fund full of illiquid assets, it might have to sell at deep discounts at the cost of the investor. So ironically, the feature being promoted as a benefit, access to private markets in your 401k, could be the exact thing that causes real damage during volatile times. If you're seeing these options pop up in your 401k plan, or you hear about new exclusive offerings, please reach out before considering anything like this. We're here to help you cut through the noise and make decisions that protect, not jeopardize your long-term security. In conclusion, private investments can have a place in certain portfolios under specific, well-understood conditions. But adding them to mass market retirement plans and forcing daily liquidity on fundamentally illiquid assets, that's not innovation, that's a mismatch with real risks. Thanks for watching.